adjusted what? Adjusted present value. We'll get there. Okay, so the required of this question, we have two requirements, right? For the two financing activities being considered by the directors, you can see they are considering two financing activities. Class, they are considering what? Two financing activity. Now, in these two financing activity, they are considering two financing activity. What are the two financing activity? We don't know. Being considered by the directors of Yinco PLC, prepare forecast. That is, you have to prepare the forecast. You have to prepare the forecast based on two financing activity. The income statement for the year for the year 30th December, 31st December, or 30th December 2017, and the statement of financial position for 30th December 2017. So they are considering two finance. So which means that the forecast will be based on two financing activity. Two what? Two financing what? Activity. Now we need to read the question so that we know the financing activity. Write a report to the directors that evaluate the proposed method of financing the expansion. You need to write a report to the directors that evaluate what? The proposed method of financing the expansion. Now, we move on to, let's quickly check the question one after the other. Okay. Yinka PLC is a printing and publishing business. The business has traded. That number two question is more difficult than this. Right? It's more difficult than this. The business has traded very successfully for many years, largely on the basis of a lifestyle magazine, which has sold well due to the competitors. However, has resulted in a need to invigorate the product. 10% per annum for the foreseeable future. 10% of what? Away. I've missed out something here. 10%, 10%, 10%. Oh, I've actually missed out something here. Oh, sorry. Please, quickly, you can add this. A plan to launch. Please add this. New magazine titles by the directors is expected to increase. Probably maybe I will resend this particular one to the platform, but I don't want to send the suggested solution. No, I won't send it. Revenue by 10%. Okay. So this is it. Class. So please, you can correct that you printed it. You can change this, right? You can actually add this part. Now, a plan to launch new magazine title by the director is expected to increase revenue by 10% for the foreseeable world future, which means that revenue will increase by 10%, right? Which means revenue will increase by 10%. Please, you can add this part to your material, right? In order to finance the expansion, the director are considering either right issue or new debt. You can see the two financing options. two alternative financing options. You can see that is why I said once you read the question, the required. Now, the required is saying that prepare a forecast based on the two alternative financing options. Now you can see now what are the two financing options? The right issue and the debt. So we are to prepare a forecast based on the right issue as well as the debt. Now, other relevant information is as follows. The level of competitors' rivalry between suppliers to this industry is very pronounced, and as a result, an increase in direct cost of only 8% per annum, which means that the direct cost will increase by how many percent per annum? Will increase by 8% per annum. Next, depreciation. Depreciation on non-current assets existing at 30th December 2017 is forecast to be, this is the depreciation, they've calculated it to be this at the end of the year. And it is forecast that 10 million of the new current assets will be needed. Okay, this is the new current assets, which will be 10 million. This together with the new inventory will be required in the year to 30th December 2018. Depreciation on these new assets will be 8% on reducing balance basis starting in the year of purchase. Class, there is depreciation on non-current assets existing, and they will now buy new assets, 10 million. And these new assets, there will be a depreciation of what? 18%. Class, are we getting it? Hello, class. I need to confirm that. Are we still together? Okay. That's fine. So, where is Kwemisire? Are you still in this class? Oh, she's not. Okay. Now, we move to the next one. The company pays tax at 21% per annum in the year in which the liability arises, and capital allowance are available at the same rate as depreciation, which means there will be a capital allowance on depreciation, just like the way we did the other calculation, right? Now, annual dividends are payable the year after the year in which the profits are earned. Dividend payable, right? Dividend what? Dividend payable. Annual dividend are payable the year after, which means that when they declare dividend this year, they will pay it year after, in which the profits are earned. The company intends to maintain the existing payout ratio, right? Payout ratio. Don't forget, dividend will be paid from what? From your profit. Now, what is the existing payout ratio of this dividend? How do we determine the payout dividend? How do we determine payout ratio? Because dividend will be paid from your profit after tax. Now, the question is, how do we determine the payout ratio? How do we get the payout ratio, the existing? Now, okay, we'll get there. So this is the income statement. This is the statement of financial position, right? This is the statement of financial position. You can see the dividend payable this year. At the end of this year is this. Now, the statement of financial position includes dividend payable as a current liability because dividends for the year have not yet been paid. You can say have not yet what? To be paid. For the purpose of forecasting, the dividend that will be paid must be included in the forecast, and so is included in the statement of financial position for what? for convenience, which is that when you pay a dividend, when you pay the dividend, it will be in your statement of cash flow as, but if you are yet to pay it, it will be in your what? In your statement of what? Financial position. So you can see the proposed financing method. One is right issue, one for 5 right issue at 5 naira per share, 15 million term loan at 8% interest. So they are considering two alternatives, which is the right issue and debt. So we have to prepare the income statement based on the right issue as well as what? Debt. And this is simple. I think this question is about 20 marks. Yeah, 20 marks. Then, class. So are we good? Should I leave this question for you to solve? Wait. Should I leave it? I mean, your mic. No, they send me all those things. Keep on. Play.
So these days
Oh,
you don't they hash these days. Oh. I don't go lie.
eh. Okay,
No
okay,
flex with
okay.
us, I beg. I beg.
Oh, no, no, no problem. We did together. We gather there. Ashke, for where? So, okay. I think I said we'll end this class by 10:30. Sincerely, I'm actually tired. I'm just kind of manage myself, right, for this class. But let's quickly just see how we can we can just do something in this question. I think I need to paste this one down. Who's that? I shot. Meet your mic. Oh, I will help you to meet your mic. Suggested solution. Suggested solution. What is the name of the company? Is Yinko. What did they say we should do? So we need to prepare a forecast. We need to prepare a forecast statement, right? How should we put it? Forecast statement. Uh, Forecast income statements. Forecast income statements. Forecast income statements for the year. Um, for the year ended. They use 30th to just set them to use the 30th December. I don't know. 2017, right? 2017. So, so two financing alternative. So you now write issue, write issue. So the next one is loan, right? Loan, 8%, 8% loan. This is one of the ACCA question, right? It's one of the ACCA question. Please make sure you go back to those questions. They are very important, right? So I won't come to this class and solve one simple question and go and assume you've understood it. No, no, no. It's not done that way. Please, you have to practice questions, right? Most of our questions, all of our questions are standard questions, are examinable questions, right? So please go back to it. It's very important. 8% loan stock loan, because they are considering two alternatives. That is why we have to do it this way. So we start from the revenue. We're told that revenue will increase by 10% earlier. That is 1.1 times. So what is the revenue given to us in the question, class? What is the revenue given to us
It's
in the
1,000.
question? Okay, okay. It's 1,000. So I don't need to scroll up and down again. Just give me a figure, please. So we'll move. 81,000. Okay. What do you have here?
89,100.
89,100. And it will increase. It's possible feature, right? So on right issue, revenue. On loan, revenue. Put the same or what? Amount. Who is that now? So what do we have here? Figure. Where is Aisha? Aisha, give me figure. Aisha, give me figure.
Sir, is it not the same year?
8,000 10 naira. But sir, are we supposed to use 81,000 naira or 89,100, sir?
Why will you use? Okay. Thank you. Thank you. I was looking at it different years. Sorry. Thank you. 89,400. Thank you. So the next is direct cost. Direct cost. Our direct cost will increase by 8%.
45,600. And to increase
Okay.
by yes, sir.
8% times
600.
45,600.
49,248.
49,248. So why are we doing it like this is because we need to prepare the cash flow statement based on the two alternative financing. So we'll do a report on that. So after that, there is depreciation, right? From our income statement, there is depreciation and indirect cost. And we're given the depreciation. The depreciation here is 5,700. Don't forget 5.7 million. They've even mentioned it already here. 5.7 million, which is the current year depreciation, right? Then when you want to determine the new depreciation will be 8% on reducing balance method on the cost, right? 18% on the cost, right? So I don't need to do much. 18% on the cost will give us the new depreciation of the new asset, right? So I will just say depreciation. The old assets is 5,000. The depreciation is 5,700
5,000.
plus the how many percent? 18%. 18% of the
Yes,
cost
sir.
of the asset. So the cost of the asset
1,800.
is, thank you. So give me a figure.
Total is 7,500, sir.
7,500. So the next is 7,500. So the next from our income statement is indirect costs. So indirect costs, don't forget I said I may just do this part and then so that we need to go. So this one is 12,000, right? 12,000. So they said it will increase. Did they give us any increase of indirect cost? No, right?
No, sir.
There's no note on the indirect cost, so it will remain the same, right? indirect costs will remain the same as 12,000. Oh, 12,000. So you get profits before interest and tax and tax. So what is the profit before interest and tax? What is the profit before interest and tax?
20,332.
Okay, coming. $20,352.
352.
So the next, this is 20,352. Alright. So the next one is finance. So from the income statement given to us, there is finance what? Let me check. From the income statements given to us, you can see what we are using, right? That is the interest payable. That is the finance. Interest payable. Let me go there. Interest payable. They didn't give us any information about the interest payable, whether it increased or something. So we can have interest payable. Interest payable 1,500. Don't forget that, okay, let me put it like this, 1,500. Now, do you know that this is for right issue? What is right issue? Right issue means that you issue a shares below the market price, right? You issue a shares below what? Market price. Is that not so? That is what? Right issue. And there is a loan here. Is that not so? Now, in this case now, right? In this case, we have the interest payable for the right issue to be this and the other one to be that. Now, the question now is, there is an existing, what is it called? There is 8% loan interest. There is 8% loan interest. That is the new interest rate. There is 8% loan interest on one of the finances that they say we should do. Class, there is what? 8%. Let me quickly go back. There is 8% there. Loan interest. So which means that we need to add the new interest rate, which is what? The 8%. Class. The 8% of 15,000, what do you have? 8% of 15,000, what do you have?
1,200.
So 1,000 what? 1,200. Class. 1,000 what? 1,200. So we can say um interest again, right? So this will be new because you don't have interest on right issue, right? Because right issue is shares, right? Then what is the 8%? Let me say 8% of 15,000. I will tell you the reason why. Okay. So this is what? 1,000 what? 1,200,
1,000.
right? Okay. Now, the reason why you have to put this, because this right issue, you have to put, the reason why you have to put this on, this is an existing interest payable. So, and we want to use it to determine the profit for the year. That is why you have to include it. But the next one, which is this 8%, this 8% is on the is on the debt financing, not on right issue. The one that is on right issue is this. Why the one that is on debt is this, class? Do we get that? Are we good?
Yes, sir.
I mean your mind.
Yes, sir.
Okay,
100.
okay, okay. No, 1 million. They play. So, so after this, you have profits after tax. Profit before tax. Sorry. So you give me figure for profit before tax. So figure
18,852.
18,852. Next. The question did not say, thank God, the question did not say you should do uh, cash flow. But you can do it, shall. If you want to show
17,000.
your okay, if you want to show your skill, you can do it. Exclusive. Aishat, if you want to show your skill, you can do what? You can do the cash flow statement, right? For confirmation. So after the profit before tax, so we go by saying tax. Don't forget that we already have depreciation. We can't charge tax. Tax is about how many percent? 21%, right? So, we can't charge tax, yeah, because of the what? Because of the depreciation. So, we need to go by that rule, the way we did it the other time, right? Because there is actually what? There is actually capital allowance. So, let's quickly go back to the part of, oh, 30. Okay. And capital allowance are available at the same depreciation rate. Is that not so? So let's go back and say workings. Workings. Now will do the profit or loss. You will do the one of statement of financial position. Workings. Oh my God. Let me just copy this. I think just have to copy this. Oh, this part. Profits. Profit what? Profit before tax. So away. Profit before tax, right? Profit before tax. Um, Profit before tax. So, class, what is the profit before tax of this? We add back depreciation. We move ahead the way we normally do it.
They can't raise.
Okay.
Okay, so the thing is that I just saw something now. We were told that the capital allowances and depreciation are of the same rate. So do we need to add back to the data?
Yes. Let's show it. Okay. Let's
All
show
right, sir.
it. Hmm. So, what is the profit before tax? Quickly, what is the profit before tax? Okay, you didn't capture this, right?
18,000.
18852.
Okay, okay, okay. 18,852. 17,652. You add back depreciation. Okay, I get it. I get what you're trying to explain. So what is the depreciation? The total depreciation that we add, 7,500, right? 7,500. I carry a points. Don't worry. 7,500, right? So the capital allowance less capital allowance. So we'll go to the workings and capital allowance is on straight line method. Thank God they didn't give us the numbers of years, right? We're not given the numbers of years that we will say, oh, we want to. We're not given the numbers of years, so we just what is the cost of the assets? Cost of assets. What is the cost of the assets?
10 million.
10
Take your
million naira.
material, 10 million. So capital allowance, TA, will be 18%. How many percent, sir? Is 18 now? Because they
Yes,
say
sir.
it's still the same thing. Okay, so what is 18% of this?
1,800, sir.
Okay, 1,800. You see the reason why you have to show it. That other way that you want to use. What do you have? 1,000?
800, sir.
1,800. 1.8. Right, so what is the tax written down value? We're not given the numbers of years, so that's why you don't need to, because we are told it's 20 at the end of 2017. Just prepare what they say you should do. The main focus of this question is based on that two financing. That is their major target, right? So what is the difference? The difference is what?
8,200,000.
Okay, 8,200,000. So what is capital allowance? The capital allowance is 1.8 million. The capital allowance is 1.8 million. Now, class, what is the taxable profit? What is the taxable profit?
24,552.
20.
24,552.
26,352.
Okay. One is 24, one is 26. Which one?
It
Which
is
one is correct?
26,352.
Capital
26,
allowance is minus, so not plus.
352. Ah, I'm
Oh,
tired
I'm
though.
sorry. I'm sorry. I didn't deduct capital allowance. That's 1,800. 24,552. I mean,
24,552. Next. Oh, next.
23,352.
Okay,
352.
23,352. So, tax, 21%. See, this workings like this. Where I copied this question from, the way they even solve itself is confusing. I have to just take, I have to just sit down, analyze the what is it called, the questions. Then I provide my own solution. And luckily we arrive at the same answer. I say, okay, I don't move on with that. So please, always make sure you understand the required. Because when you understand the required, it assumes that you have solved more than 50% of the question. Please. What is the 21% of all these things? What do you have? 21%. Quickly.
5,156.
You say?
5,156 for right issue.
5,000.
156.
156. 1,156.
1904.
Okay, I'm coming. Um, oh, Aisha, you call. Oh, let me go back. Let me go back.
That's why I
Okay.
want to go back.
Yeah. Don't worry. So let's quickly come back to this part. The companies pay tax at 25% per annum in the year in which the liability arises, and capital allowance are available at the same rate as depreciation. The capital allowance are at the same rate as the what? As the depreciation. So which means that we don't need to do any workings. It's just English that just deceive us here. They say capital allowance is still the same thing as what? Depreciation. So there is no need of you to say you add back again. Oh, you see English. Thank you, Aisha. I needed to away. Hello, class. Are we still together? Hello. They say, let me go back again, oh, so that you understand. So we don't need to do the workings. The capital allowance is still the same thing as the depreciation. And the depreciation is still the same thing as the capital allowance. So there is no need of saying add this, less that, because the depreciation is still the same thing as what? The capital allowance. And why are we doing add back? Is because we said depreciation is not allowed. That is why. But the depreciation value and the depreciation value and the capital allowance are what? Are equal, right? So are we good? So we don't need to do this workings. So we have to move on. Sorry about that. We'll waste about how many minutes here? I beg. So, so what do we have? What is 21%? 21% of this, what do you have? 21% of this, what do you have?
3959.
3959. Okay. Next. Okay, the same. What is the 21%?
3,707.
Okay.
3,707, sir.
Okay. So, what is the profit after tax? Profit after tax. Figures. What is the
14,893, sir.
Okay, I'm coming. Profits. Profits after tax. Profit after tax is what? Profit after tax.
14,893.
Okay, 14,893. Next,
13,945.
13,005.
13,000. Nine what?
45.
Okay, so we talk about dividend, right? Before you arrive at your retained earning. Dividend. So what is the principle in the dividend? Let's quickly go back to the question where they mention dividend in your Roma figure. So annual dividend are payable are payable the year after the in which the profits are earned, right? After the year, that is what they, so we assume that it is dividend, right? That is dividend declared. They will pay it in the following year, but we have to include it in our forecast, in the profit or loss. So how do we get the value of the dividend? It is calculated as the company intends to maintain the existing payout ratio. Don't forget, you pay dividend from your what? From your profits. Is that not so? You pay dividend from your profits. Is that not so? So, and they want to maintain the existing what? Payouts. They want to maintain the what? The existing payouts. Class, what is the existing payout? How do we determine the percentage of dividend from our profit after tax? How do we determine our payout ratio? Class, how do we determine payout ratio?
That's profit after tax now.
Market,
Minus preference shares dividend all over number of shares.
We
market price per share over earnings
okay,
per share.
exclusive. You
Yeah.
say what?
He said, how do
Exclusive.
we determine what?
Payout ratio. Just say what you said something now. Just
The
repeat it. Sorry.
payout ratio is determined by the earnings
Okay.
minus the earnings minus the dividend. Or you can say
Okay.
the payout ratio is one minus dividend
No,
payout.
just use that one. No, just say the first one. Earnings.
Earnings minus preference share dividend over number of shares. That's dividend per share. Then the earnings minus dividend payouts will give us the, what's it called now?
No.
Okay, wait. The payout ratio one minus
Leave all
dividends.
those. Leave all those. Leave all those formula for cost of capital.
Okay.
If you want to pay dividend,
Mm-hmm.
you pay dividend from your what? From your profit. Is that not so?
Yes, from the earnings.
What is the profit? How many percent? If you want to get the percentage of the dividend from your profits, how will you calculate the percentage of dividend from your profit? Is
Is
the
this
total dividend?
dividend is this dividend over the profits paid?
Yeah, dividend divided by the profits.
Yes.
For you to, yeah, dividend divided by the profits. That is what you will
That's a
get the
ratio.
percentage of dividend from the what? From the profit, because it is based on existing. So they will pay dividend based on the existing, right? Workings. You pay dividend based on what? Existing payout ratio, which is what? Dividend divided by profits after tax. Existing payout ratio. So what is the dividend given to us in this question? So they pay dividend based on existing payout ratio. We want to get the payout ratio so that we will use it to apply to the profit after tax here. What is the dividend? You have question, oh class. What is the dividend? Oh, 76,
Yeah,
76.
7,697 or something. Seven
Okay,
nine
divided.
seven six
Okay,
seven nine.
okay, 7679. Okay, I'm coming. Oh, 7679 divided by this. So what is the payout? What is the existing payout ratio? What is the existing payout ratio now? When you divide what you have, how many percent? Class, how many percent to
60.
60? So 60%. So we pay the dividend based on the existing 60%, right? So we pay the dividend based on what? Existing 60%. So are we good? Are we good? So we are following question. No, this is not cram question. No, It is what the question say we should do. We'll follow it, right? So 60%. So we pay it based on the existing. So what is the 60% of profit after tax? What is the 60% quickly, class?
8,936.
8,936. Next, what is the 60% of this?
8,367.
8,967. So what is the retained earning?
That's it. The balance.
So what is the retained earning?
5957.
Okay, so thank you so much, everyone. And this will be the end of our lecture tonight. What do we have?
5957 for the
five
first
nine
one.
five seven. You complete the statement of financial position, so you can test it by
So,
preparing the cash flow statement.
hello, sir.
I'm with you, Aisha.
Okay, so what about this rights issue? Those I don't even know how to explain it. The rights issue is it that the number of our shareholders like this is going to increase since we are giving issues like right issues to our existing shareholders. So what I don't know if our dividend is also going to increase as per the rights
Oh,
issue that we're increasing due to our mode of finance.
Aisha, do you want to set question for yourself? No, just tell me. Answer this question. No, see, don't set question for yourself. Oh. See, leave them. Just this is forecast. Oh. It is based on the information given to you in the question. They said dividend is based on existing payout. We know there will be a dilution of shares, but they did not tell us that our dividend will increase or not. No, the dividend is based on 60%. You can see that the 60% of profit after tax is different from the first one. The right issue is different from the what? The 8% loan. Is that not so? That is why we say 60% of the first one and the 60% of the second one. Aisha.
Yes, sir.
Okay. Favor.
I think she's talking about the statement of financial position. The share reserve is going to increase
Yes.
by.
Yeah, it will increase now because there's an additional one for 5 shares. Class. So that one will not take effect here. This is just profit or loss. So please do your statement of financial position. You do the reporting, send to the platform, let me assess, right? Or you can check one of these past questions is there. Whichever one you feel, right?